Okay, good evening, guys. Welcome back to Not So Late Night Show. And today's company in the limelight would be yet another tech company, yet another one. I think there are a lot of tech companies in Malaysia, and we have been covering quite a number of them already ever since Not So Late Night Show started. So I think what US Industries is one of the companies that you guys suggested, and we took a deeper look at it. We'll talk more later on what does ES Industry do and what is EMS, what is Electronics Manufacturing Services, and after that, you guys will decide yourselves whether ES Industry is a potential investment or not. That's why the question mark there, right? But before we actually talk about VS Industry or the company as a potential investment, do note that a lot of tech stocks have been going up quite a lot for the past few months, and for the past few weeks, there have been some correction. So it really bounds to our own risk appetite and our judgmental call whether this correction is the time to actually enter into positions into tech stocks that you might like, or is it really the end of the tech bull run and the world now is actually more focused or concentrated on recovery stocks, your staples, your banking stocks, because it is evident. If you look at the so-called COVID infection numbers, it has been coming down a lot, like suddenly, and vaccine has proven to be very, very effective. Of course, there will be some side effects, but nonetheless, the overall picture is that staples, recovery stocks are back in team. And if you want to choose a tech stock to invest in because of the correction, will VS Industry be a candidate? But before that, maybe I'll ask Chun-Ping, what do you think about VS Industry? And from the so-called tech value chain or semiconductor value chain, where do you see VS Industry?
I mean, one of the key things that you will find out, actually, they are not in the. I wouldn't say they are in the midstream lah. They are probably more to mid to lower kind of stream, and then this will actually make their profit margin not that handsome if compared to a lot other semiconductor or tech stock that is very famous in Malaysia. So I think this is one of the big drawback. But of course, when we talk about low margin, it usually need to tie with a very high volume, and then you can make a very good impact. So I think we can find out. We can start the session today to share with you what they did, and then what is their current performance, and then what is some of their competitors.
Okay, so here we go. VS Industry, tonight's Not So Late Night Show. And good evening, guys, for those who just joined. So as always, a little bit advertisements. We will be holding our first ever Dividend Gems sharing session this coming weekend on the 6th and 7th of March. It will be a 2-day event via webinar, 10 a.m. to 4 p.m. And of course, due to this is the first batch offer, we are actually positioning the price at 388. For upcoming future batches will be starting at 488 lah. So what is Dividend Gems? Basically, inside Dividend Gems, you get the complete steps and criteria to screen up for good dividend companies. And it is specifically split into 3 sets because you would need different criteria and different requirements to find dividend companies that are in the normal one. That means the normal bread and butter companies for running a business, your financial companies like your banks and insurance, and last but not least, your REITs. So each of their business operations are different, hence you have to monitor and look after different sets of criteria to screen through a good dividend company from any 3 of these segments. So you'll be learning and getting access to special metrics and KPIs for certain industries and companies. Once you actually master or get hold of this checklist, you can just replicate the strategies and find dividend companies all around the world. So somewhere down the road, you want to invest outside of Malaysia, you want to invest in REITs in Singapore, then yeah, you can use the so-called REITs checklist under the Dividend Gem sub-segment and actually find for good REITs that actually pay out growing potential growth in terms of dividends kind of REITs in Singapore. Same goes to banks and whatsoever. And the moment you sign it up, it's free for life. You get access to the replays, the materials, and in any time from now until the so-called in the future, if there is any other criteria or any other information that needs to be refreshed on the course, you will also get the updates free for life, right? We are not going to, charge you every time or every month or every what. So last but not least, all the materials, the video replays, we also came out like a ebook kind of reading materials for Dividend Gems. So you get access to that as well. And if you're interested, we'll definitely try to check out the links. We'll be posting the links on the comment section. And we look forward to seeing you this weekend if dividend investing is your cup of tea. Then that will be it. Disclaimer, whatever we're going to be sharing today will be just for education purposes and sharing purposes. We are not accredited financial service provider, so please do not take what we actually encounter, we actually portray in our slides as an investment decision, right? Do your due diligence. We will definitely not be showing what is not true. Facts, figures are actually from reputable websites, but if you want to make the investment decisions, do further due diligence. So I'll pass it to Junbing to talk about what is VS Industry Berhad, a little bit background on it, and what does the company actually do.
Yeah, so I think VS Industry has been in the market for quite some time, and they even got listed back in 1998. Malaysia is not the only stock exchange they are in. They also list their entity in Hong Kong back in 2002. So it's a very long history. They are into this area, which you might came across this thing quite frequently if you are in the semiconductors or manufacturing line. So this is the short term called EMS, which stands for Electronic Manufacturing Services. And then they are the provider to support a lot of other players that is within that value chain. So one of the good things, proud thing that being shout out by VS Industry that is they has been ranked as within the top world top 50 best global EMS provider for 13 consecutive years. From 2007 to 2019 but of course 2020 is not concluded yet when we check out the annual reports. So probably they will get another year inside this top 50. So it's a relatively good and consistent achievement that you guys should take notes. It's a long, it's a company with a long history and has been in the industry for many years. You can go to the next slide. So I think from the name itself, you might be able to guess basically you are trying to doing some manufacturing activities to all the electronics components. So this is some of the activity that might be able to carry out by EMS provider. So for example, your PCB board, you want to do some assembling work, cable assemblings, and so on. So when you talk about EMS, they usually are at the ODM and OEM kind of level, meaning they provide the services on behalf of someone else that have the brand or have the design. They will do the services for them, mainly on all these electronics box. And then it didn't involve, as in it involved in quite a bit of things. Besides assembly, they also do a little bit of design, which is the contract design that they see it. And then including testing after they do the assembly. So some of the prototyping plus some aftermarket services, which is, it depends on the player whether they are into it or not. So this is in general what EMS players are providing. If you go into the next slide, then you will be able to see what VS industry is actually providing. Right. So basically, they are trying to tell you they are inside this. They're offering it in a vertical integration manners, meaning start from product design, the mold design and fabrications, down to the manufacturing of the PCBA, electronics and mechanics, and also some of the finishing process, which is involving some plastic injection, and lastly is the assembling and the after manufacturing services, supply chain, all those things. They provide this thing, right? So this is the services that they provide. If you go to the next one, is it's a business model behind them, where they are into this. So if you see the small blue colored line, it represents the level they are in. So they are providing either ODM or OEM services, covering some of the industry. You can see it on the right hand side. So mainly in audio, computers, telco, some automobile industry, and this is the four key industry, and they also do some of the random contract job that managed to secure throughout the year. So ultimately, they didn't own the brand. They are the one that providing the services to those who have the brand. So this is something that will impact their profit margin quite a little bit. Later you will see it in their financial performance. So they have a couple of facilities across a few regions. Of course, Malaysia is the main one. And then they also in Indonesia and China. China, the key one is in JuJuR, somewhere I think around Hong Kong, Macau, that kind of area. So they have the facilities there, mainly providing all these services, the design, assembly, injection molding, and PCB assembly. So this is different country have different facilities. Of course, Malaysia have the most, and then it spread across, and then this will actually help when they try to serve a particular market. For example, in the greater China, then they will use the services or the product that come out from the factory inside JuJuR that I mentioned just now. Okay, so this is their corporate structure, quite complex one. I will go into it in details, but one of it is if you go into the if you go from top, the third row on the left, that is the one that hold the international entity. That when you go down, you can see Hong Kong and so on. So this is the party that actually hold and then become the party that got listed in Hong Kong. So and then of course, because they are into so many different line of services within EMS, all these different company, some focusing in sales, some focusing in manufacturing, but different products. So I won't go into details. So basically, they got different entity across different regions. They're supporting their business. Okay, so this is some of the key highlight that they managed to achieve during financial year of 2020. So this is the number that they managed to take. They are able to churn 3.24 billion, although it's slightly lower if compared to 2019, but it's relatively well if you compare the last 3 years. So even though a little bit dropped, but then it's still relatively good, even though they got hit quite badly during the pandemic time. They cannot open up the factory and so on. The next is they are having a very high ratio in terms of cash and cash equivalents. Also very little debt in their balance sheets. And if you go to the right hand side, is some of the achievement they managed to secure in their industry. So if you talk about EMS player in Malaysia, they should be the largest. Later we'll cover their competitors. If you can check out their share price, check out their revenue, I think they are very far away from VS industry. They are definitely the leader if you talk about EMS provider in Malaysia. So if you can go to the next one is some of the financial performance that broken down by different region, and you are able to compare it between FY 2019 and the current FY, which is 2020. So you can see, still the same. Malaysia contributed the most. There is a 700 million drops in terms of absolute revenue number. Indonesia is the least impacted one in terms of number. They are doing relatively well. Inside their annual reports, they also got mentioned they are able to continue with operation during pandemic periods, meaning March to April or even June, the peak periods. They are still able to continue with the operation. That's why they didn't got impact that much if you compare to the rest. But of course, one of the key thing is you can see a gray bar that come out only in FY 2020. So this is some of the sales that they managed to secure from US and so on. Some, which is, I think is a very good signal. They start to diversify their sales portfolio into different regions. So these are some of the key highlights in terms of revenue. If you go to the next one, yeah, majority of the customers still come from Malaysia, and then their top two customer actually contributed about 50% of it. And you can see customer A is particularly important for them, has been giving them the sales. I think if you trace back to 2018 and so on, they're one of the loyal customer to them. But of course, we didn't really able to find out their customer name. But then so far, this customer has been stable. I think we can go to the next one. Okay. So if you guys are interested to find out who is our competitors, you can check out these two companies. The closest to them is actually SKP Resources Berhad. But then in terms of the revenue size, I think they are only half of them or even lesser. ATA is another one, ATA IMS. Or another name is called Denko, I think the product name and so on. But these two is relatively less famous, I would say. But then if you're in EMS industry, you will know them. So these are some of the competitors. But of course, one of the key difference beside the revenue size is the PE ratio. VS industry is the one that's slightly pricey if you compare against the PE. I mean, you look at the PE ratio alone, VS industry may be slightly expensive from the formula perspective, but then undoubtedly they are the leader from in Malaysia for many years already. So it also contributed back to on why their PE is high. Okay, I think this one will pass. I'll pass to Jupan to continue with it.
Okay, so yeah, I think even before we started talking about VS industry, we already give a little bit of insight that it is at the so-called almost at the end of the so-called tech or semiconductor value stream. So basically, fixing, connecting, handling PCB boards, and then in charge of ensuring circuit is actually connected. All these kinds are actually considered end stream, and of course you have to be very aggressive in terms of your price that you charge to your customer, because there are also other people out there who can also do the same job, right? And to actually be more competitive, you have to actually ensure in terms of pricing you are the sharpest, and how you grow is actually by volume. So when you look at the 10-year historical income statement, you already see that all of this actually paid down the picture of you straight away. The net profit margin is not fantastic. Even if you look at the gross profit margin level, is also just around 10%. So for every 100 ringgit, this company earns 90% of it goes to mandatory costs, raw material costs, your so-called labor costs, etc. So they are left with just 10 ringgit gross profit, and out of this 10 ringgit, they net it off operating your so-called admin, expenses, maybe you need a little bit of R&D, etc. So after all of that netted off, then only you come to your net profit, which is around 3%, or at very good times, which is now 6.8%, right? So the net profit margin will always hover around 3% to 6%, and it would be quite difficult for them to reach 10%. And if they really do that, then yeah, chances are they are opening themselves to competition, and competitors like ATA IMS and also SKP Resources will maybe take away their market share. So it always has to be a very sharp and aggressive kind of costing that they are doing, and this is how they maintain their moat and actually also seek to increase their market share as well. So you can see that for the past 10 years, just apart from the net profit margin, revenue has been growing. In fact, it even went up more than around 4 times, from 1.2 billion up to 4 point something billion, right? But as mentioned, 2020 was a year where a lot of companies got impacted by the pandemic, so it slowed down. But nevertheless, I think if we were to really agree and be more confident that things will start to improve, the economy or the country will slowly get back on track post-pandemic recovery, not just in a market point of view, but really from an economic point of view, then yeah, you would see that it would not be very difficult for VS to actually record back the kind of revenue that they were achieving in their peak, which was in 2019 and 2020. Next, we go to the balance sheet, how the company is being run and being operated. So you can see that one very good sign is that the total liabilities, or particularly the debt of the company, has been coming down a lot ever since 2018. It started off with around 0.65 billion, and it has came down year on year, and until quarter one of 2021 is just 0.3 million already. But one thing I was curious actually was item number 2, where total assets actually came down quite a bit lah. So 3.1 billion, it came down to 3 billion. So usually this is not a good sign, usually. So after going through the so-called balance sheet, and I discovered that it was due to a reduction in the fair value of other investments. So we talked about just now how many subsidiaries and investments VS Industry has, right? So some of it, they actually hold it under, how to say, they actually own a certain portion of shares in these subsidiaries. And this valuation of these companies is actually marked by a fair value gain or loss. So if those companies actually decrease in value, then you will see that they will also reflect this fair value of other investments, and that will also impact their assets as well, right? So that actually came down and contributed. And another part of it is that during 2020, it wasn't a good year. Of course, this company actually earns revenue by going into contracts with their so-called service party. And if they manage to get a contract, they'll actually recognize it as a contract assets and park it under their assets. So if your so-called assets, your contract obligations with your customer reduces, then of course it will also impact your assets as well. So what I want to see moving forward is, if the company is slowly recovering from the one-off pandemic, your contract assets should actually build up back, and I don't want to see that the total assets continue falling. It should be recovering, and you should see a little bit of a increase in terms of the total assets moving for the next few quarters lah. For the cash flow statement, I think it's pretty much straightforward lah. So of course, this company isn't shy of doing expansion. You will see that how they actually grow from one company, and then they have so many subsidiaries already. But for the past, at least for the past few years, it has been relatively stable, and I think maybe it was the right thing to do. Maybe they still had the capacity. It was not really that urgent for them to venture into some major capex expansion. So you can see that in terms of the operating cash flow, it has been increasing steadily. And in terms of the mandatory so-called PPE kind of expenditure, they actually incur it. And then in terms of the financing, which they need to manage their so-called financing for whatever reasons, it's still within expectations. There's no big gyrations, and for the past 3 years and even the trailing 12 months, you will see that the company is having some free cash flow. So even worst case scenario, if the pandemic were to worsen or whatsoever, catastrophe were to happen, at least in terms from balance sheet strength, this company is pretty much in good shape lah. You wouldn't be very worried that the company might run into some liquidity issues lah. But overall, I would say it's just normal. We have come across better companies or more sexier companies in terms of their balance sheet and their operating cash flow. But of course, this is a very competitive business. There are only some kinds of levels of achievements that you can do. So after going through all that, this company is also a company that pays out dividends if you are a loyal shareholder. And if you look at the dividends, you might also wonder, how come for the past early 2010, meaning from fiscal year 2011 up to fiscal year 2015, it has always been around 9 cents, 15 cents, and 11 cents. So roughly about 10 cents plus. And now, for the past few years, it has dropped down to 4 cents, 5 cents, and even 2.6 cents. So if you really check back how the so-called share split or bonus issue actually happened, it happened in 2015. So if you were to be holding the shares back then in 2015, of course you will have been the recipient or the beneficiary of this subdivision and bonus issue. Which is why you will see, even though from a per share basis, it actually went down, but if you tabulate back, it has been pretty much consistent, and you can only argue that because for the past 2020 financial year, due to a sudden misperformance by the pandemic, then you will see that the trend actually broke off. But other than that, it's pretty much flat. And apart from the 2018 bonus issue, you didn't see that it caused any dilution effect on a per share basis for the dividends. So I'll pass it back to Chun Beng. We talk about prospects of the company, since this company is not shy in setting up subsidiaries and growing its business. What do we have for prospects of VS industry?
So if you remember just now, I shared the pie chart. I don't know if it's pie chart or graph chart, I forget already. But it actually showed that there is some other region giving contract to VS industry. So out of the few, there's two come from US, and one of it is called Victory Innovation Company in, and they are the leading sanitization solution provider in some chemical application equipment. And then if you read this thing, you might link to COVID-19, link to vaccine and so on. So it's true. They are supporting this company, and then this has been giving them some good contract that help them to actually has secure them from achieving above 3 billion revenue in FY 2020. So this is some of the key things. And then because of that, they are very confident that they will be able to, as in they will receive more and more orders to support different customer. And during the year itself, they have acquired a land for expansion using 98.8 millions to actually build a new plant, which is about 400k square feet, and end up, by next year, the entire plant, built-up area of the plant they have will go up to 2.1 million. So do expect, usually these things come together with some order forecast, and then this will lead to the management and then make them to do the decision on getting a new plant. But then what we should monitor is whether they can utilize the new plant effectively or not. So I think this is one of the key factors you should always monitor for some expansion done by the company. The utilization rate should be one of the core things you should check, because it can be promising. 1.7 to 2.1 is like a lot of percentage increase. Is this contributed back to the revenue of course, if it's fully utilized, yes lah. And then this will go back. If everything maintained, then your share price should follow lah. If the PE still maintain. So, but is it as simple as that? We should continue to monitor. So this is the few key prospect that they are having, and then this is the risk that actually hit them quite hard. I think mainly in the currency part of thing, because they have a different company across different region. They do accept contract in their home country kind of currency, for example, in renminbi and so on. So they do have exposure to different currency around the world. But you will find it interesting that why we are telling you US-China trade war is actually giving them a hit. Actually, it's a mix to them. They are the direct company that benefited from US-China trade war in Malaysia operation because of some sanction being done in China. I mean, done in China by US, all those things. There are some order coming in, but bear in mind they do have quite a big operations in China as well. So this is the part that got hit. So it's a mix in a way, but in long term, whether this US-China trade war continue, all those things we don't know. But the short term gain they've already got it back in Q2 Q3 last year. But then if they continue, they might not be in the good position if this thing prolong. So I think this is the two key risks they have. Of course, one of the things we won't call it as a risk because this is the nature of their business. Their profit margin is very, very thin, and they have huge competition. They don't really own any IP. I mean, what they have is really the experience, the setup, the advantage of having the skilled labor and so on. So these are some of the common risks that a player in slightly middle to downstream player will actually suffer.
So I think after going through, I would say interesting company in terms of the contribution that it play in the entire semiconductor value chain or electronics value chain, right? So here you have it. This is today's valuation on PS industry. PE is around 42 times PE, right? ROE return, return of equity is at 7.41%. And you look at the 12-month trailing profit margin is around 4.2%, right? Latest quarter is around 6+%. But you can actually find some solace or comfort or even confidence that the CAGR revenue growth is around 11%. So it's still a double-digit growth for the past few years, right? So you can take comfort that if semiconductor can continue to boom, then as an end-stream player, VS industry is one of the beneficiaries, undoubtedly, since they are the biggest in Malaysia. But you also need to take note that valuation-wise, it's a bit steep, personally, for someone at the end stream, and there are maybe a lot of so-called optimism and also for future earnings factored into the current share price, right? Some people might think that lah. But you look at the so-called, surprisingly, they have a dividend policy at around 40%, so they are entitled to pay out 40% of their earnings to shareholders as a dividends. And but since the share price actually went up quite a bit, you would actually be getting around 0.87% dividend yield if you were to buy at today's closing price. So there you see that it has been going up ever since the bottom back in March 2020, right? I would say it went up close to 300%. Yeah, close to 300%, below 1 ringgit and all the way up to 3 ringgit a share. So roughly has gone up by around 300%. Is there still more upside to this company, or for an entry player, this is just the best it can be, right? I leave it back to you guys to further study. And of course, if it's a good company, we wish you all the best. And not, of course, there are other fishes out there or other companies out there to actually for you to consider. So if I were to run Dividend Gems criteria on VS Industry, is VS Industry actually a potential dividend company? So if you look at for the past 10 years, they have been paying out dividends, be it a lot, be it less, but there have been some dividends out there, and they are actually having a 40% dividend policy. So non-negotiable, they pay out consistently for the past 10 years. Yep, they actually passed the first hurdle of our dividend gems. But if you were to look at the second hurdle, actually there's something not quite up to our expectations over here, which is why it actually failed the second criteria, right? But fortunately, in terms of how the company is run, being operated, we do see some safety or reassuring signs that this company will not go into deep trouble, even though if the so-called pandemic were to worsen or whatsoever, or if there is another black swan event. So fortunately, due to that reasons, this company actually passed hurdle 3 and hurdle 4. So maybe it doesn't mean that if a company fails one of these hurdles, it definitely gets kicked out as a dividend company of choice. Of course, the best is actually they pass all 7. But if they do not pass it, actually there's some justifications to be done. If you can reason out and you can accept the risk of the company not passing one of these hurdles, you can still actually consider this company in terms of the sizing inside your portfolio. Maybe just don't allocate a huge amount of this company inside your portfolio. So this is how we actually, a method that we always use to find, screen, justify, and gauge potential dividend companies. And you can actually use this checklist to screen for dividend companies, not just in Malaysia, but also for any companies around the world. And if that company actually passes the criteria, then yeah, it really does make sense for you to look deeper and to really come up with your game plan. At what price you want to buy the shares, and what price of yield that you're actually expecting from the company. Right. So of course, for those who have actually joined us in our Stock Plus 2021, in the end of January, you will see that we have just shared out the monthly email. It has been up 10% since 2021, and from end of January until the end of February, it has been up 3%. So of course, I went to check just recently. Of course, it's not 10% already because of the share market correction around the world. Is currently still at around 8% gain, right, since early of 2021. So of course the live has concluded, but if you are still interested to know which of these 10 stocks are inside Stock Plus 2021, you can still sign up, get access to the analysis and also the playback of that day's live. And of course, if you have any questions, you can email and actually come and ask us for more questions lah. So last but not least, another banner for our dividend gems this coming 6 and 7 of March. I will not repeat the same benefits and the same skills that we are actually offering to share with you guys. So if you are interested, do check out the links, and we look forward to see you on that very day. So that's about it for today. I hope you have enjoyed our sharing with you regarding VS Industries. So let's head to the questions.
We don't really have any question today.
Oh, okay. Okay.
I think
let's
just
go
a
to the
little
first question.
I think there's one comment from Hong Han. Yeah, I think it depends on appetite. You need to have a strong heart to hold on it. I mean, these few days or few weeks might be a challenging weeks for tech stock lover. But to be frank, ever since pandemic, after the huge correction back in March, I think tech stock has been on the rise non-stop. Don't really have a real correction since then. So it need to be fair. Even Bitcoin got corrected so many times. Tech stock didn't even get corrected once. So some of the things to take note lah. Yep.
Okay. Yeah. JAG. JAG. I'll check and get back to you. I heard of this company name, but I never really understand about it. Maybe Chun can give a little bit of opinion on K-Power.
Actually, we did a coverage on K-Power before their. I mean, I won't say before. It's during the time that they got boom. I mean, coming up with a very good positive news and so on, and then the share price got pumped up crazily. I would say. I think now they also suffer some correction. One of the key takeaway is K-Power after they are taken over by the new boss. The ability to secure big amount of contract is really amazing. And then whatever thing is inside their pipeline is lining up. It's just a matter of time whether they can close it or not. And then they are into a few things, not really solar, but they are in hydropower and so on. So the only key thing that you should take note is K-Power is all about securing projects and then close it. Don't really have a lot upside in terms of recurring revenue, not even on maintenance and so on. There are some, but very, very minor. So these are some of the things that you guys should take note if you talk about K-Power. But undoubtedly, they are very good in closing deals. Has been proven for a few quarters. So these are some of the key takeaway. But feel free to check out our videos. You should be able to see what is the business they are in and what is the pipeline they are trying to build.
Cool. Okay, I'll go back to JAG. So, Jack, I think they are also in the EMS, I think, right? When I look at the okay, first thing first, if you were to compare JAG's Berhad latest 2010 revenue against VS Industry, so they are doing around 159 million compared to VS Industry, who did around how much they did already? So they did around 2020 they did around 3.2 billion. So they are so much bigger than JAG. And even though we talk about how thin and how competitive the EMS industry is, at least VS Industry has been profitable. They do not have the room nor the flexibility to actually increase their net profit margin. It has always been 3+%. And if you look at the smaller guys like JAG, it has been also a tough journey for them. You can see JAG's 10-year historical net profit margin is also single digit. There are even some times where they actually slump into a loss. And the max best kind of scenario, net profit margin is around 5.8%. So it's still a little bit behind in terms of the net profit margin compared to VS Industry. In terms of growth wise, I think it's even tougher to assure or to judge or even to be more confident that JAG will grow, right? But for at least for VS Industry, at least it has a track record of growing its top line. Just that the net profit margin, you won't expect it to actually go beyond double digits. At most, historically, at best, it's around 7%. Whereas for JAG, it's up and down, very hard to use fundamental analysis or value investing point of view to find value in some inconsistent kind of income statement lah. I heard but didn't verify it myself. VS is also linked with Dyson. I also have heard some rumors lah. So proxy to those more high value kind of end stream consumer electronics. So they are the ones who actually in charge of setting up the connection, the circuit board, the printer circuit board within a certain kind of electronics. So Dyson will be the one actually selling their vacuum or their appliances to us at the high margin lah. So this is actually where you actually pinpoint companies with good profit margin that are more worthwhile or more lucrative from an investing point of view lah. All right, we will move on to the next question. Let's see. Okay, I need to refresh my browser because the internet broke off for my browser.
I think
okay.
Yeah, the next one is the favorite topic recently, talking about this increase of bond yield. I think it's a fair move by the US side to do an adjustment on bond yield, because they has been trying to do this before pandemic. Due to the fact that ever since 2008, they initiated this thing called quantum easing, basically print money to prevent those company from falling. There's some movie called Too Big to Fail and so on. You can go and check out what actually happened back in 2008. It's already printing so much. They try to actually make some adjustment, but too bad, when they are putting the effort, suddenly the whole thing got. I mean, the whole effort is gone due to pandemic. And what happened next is instead of stopping from printing the money, they announced this thing called unlimited QE, which is printing more money, which in fact is stabilized the economy right after pandemic, and then promoting the bull run of tech stock lah. So, but like it or not, money has been printed too much. They need to be corrected, or else where all this money goes to, and where it will create a lot of different kind of bubbles. Bitcoin is one of it, of course. So I would say they will continue to do so since the vaccine has been taking effect. The entire economy is in recovery mode. So they have, I mean, most of the country will have more resilient to all this economic movement. Imagine they try to do this 3 months or to 6 months back, the whole economy might collapse. So I would say there's no choice, but they need to do so due to the fact that too much money has been thrown to the market.
Okay.
Yep. Some comment. Yeah, need a deeper correction. I think it lead back to the nature of the company. For example, if you talk about Shopify, Zoom, the kind of company that link to pandemic, because of changes of shopping behavior, because of changes of working culture, working from home. Of course, the bull run of the share price has been factored in the potential, and now slowly back to normal. Of course, you need correction because the quarter-on-quarter growth of those things definitely will be slowed down. So these some of the things I think it's quite logical. But long-term wise, for me, maybe they are still a good choice to go in to look at those companies, because they are the future tools lah. Yeah. I'll pass this to Japan.
A friend shared that a storm is coming cause the spread of treasuries and equity valuation is very low everywhere, and that there is a market bubble due to global debt at all-time high. What are your thoughts, or have more cash on the side? This is a very good question, but I will give you my perspective, which might not be true because I am not an economist. I will just see it from a layman point of view. I think a huge part of your of your statement is true lah. So we talk about printing money, etc., and there's a lot of liquidity. And of course, when you put too much money onto the hands of the common folk, and things happen, right? Bitcoin going up, stock prices going up as well. And if this were to were to go out of control, then that's where the market crash actually will happen, right? But whether it will totally come down to a crash, I would still say I am not sure. I can only prepare. But if you were to ask me how internally, it means within my head, whether I think a crash would happen or not now, I would say I would still be 50-50, or I would say a huge part of it, maybe 60-70% is not going to crash. It will be volatile, but it will not totally go on a crash lah. Because the crash actually happened 1 year ago already, and with the whole world so flooded with money, the so-called logical point for someone who actually holds the stock is to actually throw it. But for some other people who actually is sitting on a huge amount of money, those who are hoping for a market to crash, when it crashes or when there's a huge correction, they just go in and buy. So there will be huge fluctuations, but there will be equal call or equal bulls versus the equal bears out there. So if you have a strong bull and a strong bear, it actually makes it very hard for a total crash to happen. For a crash to happen, you need to have more bears than bulls, so that the fear actually drives the stock market down. So, but for now, yeah, we see a lot of fluctuations, but we did not see a huge correction. At the moment, still can say that the bulls are as strong as the bears, but just that the bears got stronger, so we have a huge volatility for the past few weeks lah.
Move to different type of stock lah, I would say. I would say Disney is not impacted a lot.
Yep. Yeah.
Out of too many, Disney is quite stable in a way. So money is still there. Move to different stock or move back to a safer
recovery stocks lah. So good question, and I hope the answer was good enough as well. Can you compare between UGTech, Times, VS, and SK Press? Probably we can compare just UGTech and VS, right? Maybe I'll let Chun Bing talk about UGTech, just a brief summary on UGTech's, or maybe what's the advantage of UGTech against VS industry, since we covered UGTech and VS.
I think in terms of dividends, I mean, if you compare apple to apple, maybe from a dividend yield perspective, they might be slightly on the upside due to also they are, increasing trend and slightly steady kind of consumption behavior of coffee inside the house. If compared to VS industry, I think if you enter with the price right now, then the dividend yield definitely is very, very bad. Because the stock price has been increased a lot, really a lot, alongside with a lot of other textile in Malaysia. So it's a bit expensive in my opinion, but UGTech, on the other hand, are still manageable in a way.
Yeah. So we can't compare for our Times and SK Press, but if we look at the so-called size of the business, just now, just a brief check against JAG Berhad. When this kind of competitive business comparing side by side, is always the one with the operating leverage. The biggest company can actually give the best price, and then it can actually grow on top of that, and the smaller boys will actually face so much more competition if they go head against the big boys. So of course, I think Times and SK Press, there were some period of time where they were hot stocks lah, but it really boils down to what is your expectation and what is your thesis when you buy the stock. You can buy it for the sake of riding on the volatility and hoping to make money via the trading point of view, or if you are someone who really focuses on fundamentals or value investing, right? Then of course, from a value and from a so-called operating from a business point of view, definitely VS is a better company against the smaller boys lah. So if you want to also ride on the growth of EMS, the safer choice actually would be VS industry lah. Not to say that the rest of two aren't, but just relatively on a risk index comparison. Yeah, so I think this is why we like to do Not Solely Nice Show so much. You always have contributors giving out so-called contributions. Yes, VS is actually linked to Dyson. And how much percent? I think that is a question that we also need to find out, right? So that is actually what makes investing so interesting. So that's why its share price dropped so much from 2017, 2018 due to lesser and cancel contract from Dyson. Yeah, so this is the kind of risk EMS players would foresee. It's not the business where you expect loyalty. You cannot charge expensive margins like Uchitech charges for its coffee machine. So, and if you just lose a key customer, then this is the kind of expectation you'll be facing lah. There is a lot of talk about imminent crash. Again, would it be wise to lower our tech holdings? How does one position themselves for something like that? More cash or just safer stocks? I think it's an option of both. You can play around holding some safer stocks inside our portfolio. And I think almost all the time when we get asked this question, our answer is always to always have some cash ready for whatever kind of black swan event, right? So now when the market is volatile, maybe the more people are asking when there's a crash. But during good times, deep down inside our heads, we will always be saying that I don't know when the crash will come. It can just happen overnight. But if it happens, at least there is some cash waiting to be deployed if this kind of black swan event were to happen. We will never know when it happens. We can just only prepare. And how much cash to hold on hand, it just depends on how confident you are the market will crash. If you really believe that there will be a market crash, like some people would do, they will say, I'll sell all now and I'll keep 100% cash. But you also have to think of the downside. If really don't have crash, then how you would see the market going up and you would be left with nothing on your hand. So this one, it's just up to our personal level of engagement. I would say that I'm not an economist, but somehow or other I will still have a set of criteria or discipline I follow. Like for example, 20% or 10% of cash versus your existing portfolio. And if a crash happens, okay, then you use the cash to buy something that you think is value and something you want to hold for long term. Okay. However, we execute contract from US Home Appliances. Yep. And contract is actually larger than what we have expected. So, yeah, I think this, you are really quite informative on VS.
Yes.
So, yeah, so this is why Not Solely Nice Show is not just a one-sided communication, but a two-way sharing session. Right? Oh, so it's very, very, and actually from a few bank analysis, so good for you lah. So usually you also go through bank analysis since they also provide much more information compared to the annual report. But of course, sometimes time can be tight. So yeah, that's why we also said that it's always good to actually dig deeper, analyze deeper on a particular stock, even after Not Solely Nice Show, so that it actually bolster your confidence or actually allows you to see much more of a picture before you make any investment advices lah. Yeah, volatility is the name of the game when you play the game of stocks. Is it possible that the company profit for the coming 2 quarters will be negatively affected by the project's from the 2 new customers due to higher initial cost and inefficiencies. I think this one is on a case-to-case basis. I would say no lah, because rarely for EMS you would want to incur higher cost expenses, because it is just the entry process. Basically, it's just trying to get the circuit board inside an electrical appliances, trying to get it work right. It does not require any rocket science. At most, you might need to invest in a new tooling to get all the circuit boards connected to each other. It's not like coming out with a niche kind of stuff where you actually have to incur initial costs. So I wouldn't foresee that to happen. Even if you look at the past 10 years, even if there is some initial cost, right, the company has never reported a loss for the past 10 years. So I would take it that this is something the company can manage, and it will not really impact that greatly to the upcoming few quarters. But we'll see. I will share first. No, I think I have actually been quite bullish on tech stocks, right? But it does not mean that currently it's losing a lot of money. It's just that the unrealized gain gets eaten up a lot because I actually bought back then already. So it was maybe around since last year. Almost every month I was buying something. So a lot of it is tech stock. So here and there, I have been collecting, and of course it has been going up very high. Everything looks very nice, but just for the past few weeks, things actually corrected So am I going to sell it with the gains that I have on hand? No, I will not going to do that. I will just wait it out, and of course ensure that I have sufficient cash. And if there's a market crash, then yeah, just buy the companies and continue holding lah. Okay. One last question for the night. I personally think that big tech stocks could be some good companies to weather the storm. What do you guys think? I'll pass it to Junbing. Is big tech stocks the blue chips now? The real blue chips?
I've been adding a lot of tech stock inside my watch list. If you talk about volatilities, of course, it's much lesser. If you talk about Apple, Microsoft, and so on, during the past few days, maximum is maybe -5%, and coming up again, then -2 to 3. But if you follow highly volatile stock, Tesla, what's the name already? Palantir, is it the new tech stock?
Palantir, yeah. Palantir, yeah.
Fiverr. Those you might see down to double digit easily within a single night. This is the stock that cannot weather the storm, but whether they are potential or not, of course, I would say they are having the potential, but maybe it's highly valued the past few months. So it depends on which one is inside your watch list. Like I say, a very good example is actually if you refer to Disney. I think they got some element of recovery stock because their theme park will be reopening soon. They didn't have any impact. I would say the last few days maybe they shoot down a little bit by 1-2%, then going up again. But one interesting finding is I think SEA just released their latest quarter reports. SEA is a Singapore-based company that owns Shopee. They are the one that actually managed to secure the position because they did very well in their latest quarter result. I think almost double the earnings. So they are the only one that managed to have some green, and the rest all red inside a lot of my tech stock watch list. So ultimately, it's still down to the nature of the business. So for example, if you talk about Shopify versus Zoom versus SEA, then maybe, in my opinion, Shopee slightly more stable because you will be still continue to buy the thing from them like, in a way, even though you can go to the retail store already. But if you talk about Shopify, then it really depends lah. People retail start to opening up. Those who already joined the wave go online. It's already happened. And they were still having a new player coming in bit by bit, but whether they can keep up with the stock price they're in right now, and then the growth percentage, I think it's a bit challenging for company like Shopify that purely ride on the need of online e-commerce shop, and then boosted the demand a lot during the pandemic. So it depends on the nature of the business. Some of the takeaway but then I would say if you monitor the price movement, you know which one is volatilities. Which one is more volatile, which one is not.
Okay, cool. Okay. Okay. I think this is not the first time we receive question on gloves. Just for this week. So I think apart from you, someone also PM us and asked us about gloves, right? So I don't know whether you have gloves or not, but this particular person or lady who actually PM us, she actually has gloves lah. So she actually was holding onto them, and of course things aren't doing that well from a share price point of view, right? My take on gloves is that the business model hasn't really changed. Of course, there might be some over bullish sentiments back then during the height of the pandemic. But if you, as I said again, if you are someone who is just looking for volatility, you want to ride the volatility, this is a time where volatility also happens, but at the opposite direction, and you see the growth stock prices actually going down and down and down and down. Right, this is also volatility, but at the opposite direction. So if you are actually going in and out of the market based on the volatility, this is the negative outcome or the not so favorable outcome lah. But if you look at it from investing point of view, I would say growth business at its heart is still a recurring kind of business. Pandemic or not, it will still grow at around 10-11% for the past few years. It has been doing that, right? Maybe you can argue that now that we are more high alert, the growth might be even higher, 12-13%, I don't know. But you would need for things to settle down, cool down. If you want me to give you an example, not so good example is GameStop, right? It went up and back, went up so high, and then it came back down very fast, but then it cooled down, right? But then it actually went back up again. So I'm not saying that it will go up again, but you need to actually let the stock cool down before you can actually find some value in it. Because when the stock is volatile, chances are the prices will always overshoot the value or intrinsic value of the company. So you'll be very hard, even though you know that there's an intrinsic value for the company. Say, for example, gloves will still continue to grow, because back then so many people were buying the stock, and now everyone wants to actually cut loss or even take profit as they see their profit slowly reduce. So you will see there's an oversell reaction happening for growth stocks. Is there value in growth stocks if you hold it as a value investor? Yes, but if you are someone who cannot hold a stock, then and seeing your portfolio in red, double digits or triple digits make you unhappy and disrupt your sleep, then I will not force you to become a value investor. Best if you just take whatever gains or losses you have, and start your so-called look for another stock that can actually earn back the so-called losses that you have incurred. So of course, for me personally, I strongly believe in value investing, but if value investing is not your cup of tea, you cannot hold on to a stock and see it recover for a few years, then there's also no point in forcing you to believe in value investing. And the reason why you venture into a stock, buy into a stock, must also be the reason why you sell a stock. It cannot be you buy because of volatility, you want to trade, and then because you got stuck, then you say, okay, now I'm a value investor, I will hold the stock, right? So it doesn't make sense. So the negativity press will happen for the growth stocks for the time being. So if you believe in the long-term growth story, then maybe now is your time to actually take a look at it, right? That's all I can say.
No, but at one point, like it or not, growth stock sales have been going up quite crazily. And then a lot of people say, wow, now the PE is very low. Which is true because a lot of people anticipate that kind of growth and then they buy into it. Then after a quarter, the sales or profit kick in. Then the P, and then no one continue to buy it. So the share price actually go down to match the PE. It can be a trap because I would say the demand of glove will be slowing down after the pandemic, and then it will go on the normal growth again. But then now all the quarter result is still at their peak in a way. You see Supermax, all those things, the latest quarter is still very handsome compared to the past performance. And then this one, compared against the price, maybe it's about PE 10, PE 12, for example. But this is with the basis of their sales have been up 100%. Imagine it slow down, become 80% or go down to 50. Then your share price PE will shoot up crazily, for example. So need to be careful. Even though now the PE seems low, but this is the result of huge demand coming in during the past few quarters. So need to be very careful. Yeah.
Yep. Okay, this is also another good question. What do you think about NMSM? After so many years, finally earned 50. Based on forward PE calculation, it seems like undervalued. You say already, based on so many years. So if you get trapped this round, are you willing to wait for so many years until you see the company grow again? I'll throw back the question to you, right? JF Tech is dropping lately while other semicon going up. Can you comment, please? I think this also ties back to the growth. JF Tech has been going up crazily previously, right? And if you guys know how the stock market works, JF Tech was considered a hot stock. Everyone was talking about it. Everyone was buying it. And sooner or later, those people or those individuals who have bought the stock, they definitely want to sell the stock, right? Because JF Tech cannot pay for food. JF Tech cannot pay for houses. You need cash. So you have to sell the stock, get the cash, and then do whatever they want, right? So that would definitely happen if a stock price that has actually gone up too crazily fast. It will bounce to have some correction. So the question that you should ask yourself is this correction an opportunity for you? Straightforward, right? So it always boils down to the future movement of price. And for us, we cannot predict how fast the share price will appreciate, but based on the company's business model, how the company is being run, we are just confident that give 1, 2, 3 years to the company, the share price will definitely go up, because there is no reason for the company's share price to go down, because a good company will just continue to grow, and there is no reason for the company to depreciate in terms of the share price, right? So this actually helps us to find opportunities when the stock market corrects. I will only look at the companies that I'm confident in their growth plan. I will not look at boring stocks like GameStop or stocks which are still heavily under goring elements like JF Tech. Maybe it can even go down more. We don't know. But because back then it was so hot, many people got in. So when people goes in, definitely people also need to come out as well. So when more people come out, then more people go in, then you see some correction. So this is the volatility nature of a hot stock, and personally, I tend to stay away lah, because it's too volatile, and I don't know how to put a valuation on these kind of companies lah. Okay, last question. Can keep on hold the top growth for collective good dividend from this counter? If you look at the behavior pattern on how you get dividends from top growth, yes, I would say actually top growth is a dividend company lah. Based after I study it, just because it also has some growth element, then people are actually valuing the company from a growth company point of view. That's why before the pandemic, growth companies like top growth was at around 40 times PE. So it's a growth company valuation, but not the dividend company. But if you look at how consistent the company has been paying out a portion of their earnings as dividends, it does actually falls under a combination of growth and dividend company lah. So yeah, if you have held on to top growth for quite some time, your dividend yield is decent or even above average, then it makes sense to actually hold on if you believe that growth will continue to become a recurring business and a so-called growing business for the company lah. Right, I think hold it till the end of time. All right, so I think that's about it for today. I hope you guys enjoy PS industry. Of course, this is going to, Not So Next Show is a weekly kind of event. You can suggest whatever companies that you want us to do. Personally or previously, we have already covered companies from the US as well. I think after a few weeks of Malaysia stocks, we will be looking abroad again, maybe a stock from the US or somewhere else. But we will definitely ensure that this company is a company that for you to look more into detail, because this is what we all do. We want to look for good companies, good prospective companies to invest. And yeah, if you have a good one, you want to save us some homework, yeah, you can suggest it in the comment section. And yeah, if that's about it, we'll see you next Thursday.
Okay,
Oh,
see you.
see you next Thursday. Bye bye.